G'day and welcome to Lunch Money, where workouts, special situations and capital raising specialists give us their views on the weekly news. My name is Nick Samios. I'm the Director and Fund Manager here at Hermes Capital, and I'm your host today. So once again, welcome. Just a reminder to like, share and subscribe on YouTube or on your podcasting platform if that's where you're listening to us. Last week we saw the collapse of another private equity-backed retailer, Sule. It makes me wonder, what did private equity see in all these retailers in the first place? And more interestingly perhaps, what did all those debt providers see in retail? Because they certainly piled on mountains of debt on top of the private equity for those retail chain deals. What else is private equity up to? Is there money sitting on the sidelines and they're eagerly going over potential investments, waiting on distressed investment opportunities, or are they putting out fires in their own portfolios? The other thing that's in the news this week is extension of JobKeeper, the extension of the payment holidays by the banks. The government's talking about once again extending the relief on insolvent trading. At the same time, we've got the government and the banks in particular are saying that they're very mindful of not perpetuating zombie companies. So that seems to me to be a bit of a juggling act. To discuss these topics, I will introduce our panelists, starting off with Gary Blom from Main Street Capital. G'day, Gary. How are you doing?
I'm very well, thank you. Good afternoon. Yes, it is afternoon.
It is afternoon. It is afternoon in on the over east, as they say. But yes, we do have watchers in WA as well. So good morning if you're watching us from WA. Gary, tell us a little bit about Main Street Capital, and I'm also interested to know what keeps the folk at Main Street Capital busy these past few weeks.
Yeah, look, Main Street Capital has been operating since 2008, and we really have two specialties. And they're very different. Our first specialty has been that we take Aussie companies to the US and set them up in the US and then raise capital for them as a US company, predominantly in Series A, B and C. And the majority of the capital comes from either private equity or from venture capital. Over the years, we've taken now 46 companies to the US that fit that criteria. And that obviously has been affected with what's going on currently, and we'll cover that when we talk about retail, etc. And then the other part of our business, which is totally different, which is helping restructure and refinance companies here in Australia that are in trouble, and looking at finding alternative sources of capital for businesses that are needing to be restructured. And so that's our core two businesses.
With those capital raisings, where you're taking companies to Australia, to US capital markets, typically, what are the ranges of the capital raising?
Look, we obviously raising capital in Australia is very hard, and we have, we've been doing this, even like Main Street's been going since 2008. We've been doing it since the late 80s. We have 29,000 companies on our database. So this is when I say companies, these are financial institutions that invest, private equity groups. And whereas in Australia, you'd be lucky to have 29 companies in total.
Yep.
So we really specialise in the minimum amount is $5 million, but most of these funds, because they're substantial, you really don't even get their attention unless it's a $10, $20, $30 million type capital raise.
Yep.
So it's not startup, but it's certainly growth capital in Series A type transaction, Series B.
And what is it that occupies your professional time? Is it what do you find yourself mainly doing?
Well, obviously getting companies ready, on that side of the business, getting companies, investor ready takes a lot of effort, because when you go to the market in the US, you have to look like, feel like, smell like a US company. You're competing with a lot of people. Especially at the moment, because private equity, and back to one of the questions you asked earlier in the piece, we've been dealing with these venture capitalists and private equity groups for years and years, but more than 50% of them at the moment are focused on just simply sorting out problems within their existing portfolio. So they're not even looking at new deals. And the general comment at the moment is if we own less than 50% of the company, then we're not even looking at it. We are really focusing all our efforts on our current investments.
Yeah.
So what we normally do, and this is why what we're doing even now is interesting. Our normal model is that once we've got a company ready, we then take the management on a roadshow. It's a physical roadshow, and we might visit 10, 12, 15 states in the US. And obviously you can't do that now. When we can't travel there, we can't do that. So we've put a lot more effort back into now our Australian business, which is really waiting for what's going to happen in the next few months in the restructuring of companies that are in trouble.
I'm just curious, when a company comes to you, let's imagine that they're in good shape, their financials are presentable, and it's a sharp management team that can help you put an IM together. I mean, how long does the process take? I knock on your door and...
Nick, at least 4 months, probably 4 to 6 months. And the big difference is in the US that, US capital fund the jockey, not the horse.
Right.
And so it's really important that you've got a very strong management team, and whatever you deliver, I've always used the analogy, it's a bit like if a prince was coming to Sydney and wanted to find a princess and invited 100 girls to go to a dinner, you'd want to make sure that if you're invited, you got the best dressed and the best hairdo and the nicest shoes, etc. And that's what it's like when we take companies to the US. It's like a beauty parade.
Yeah, they do call them beauty parades. Okay. Well, look, Gary, we're just going to put you on pause there for a moment while we introduce our next guest, Sule Arnautovic. How are you going, Sule?
Hey, Nick. How are you?
Very well indeed. Well, what is happening indeed? We had you on, I think, one of our early episodes, episode 2 or 3, and this is our 16th thus far. So we certainly couldn't have done it without your early involvement, Sule. That's for sure. Back then, it was the early days of COVID, and we weren't really sure what was happening. And now I've got you back again, and Melbourne's back in lockdown. Quite tragically, Victorians right now have to deal with the indignity of the AFL Grand Final being played in Sydney, amongst other things that people have to contemplate. What is it that keeps you busy these days, Sule?
It's I'm an insolvency restructuring guy. So the last few months have been sort of well written about, quite quiet in insolvency and restructuring. All the stimulus holidays that have been announced have essentially enabled people to kick their debt problems down the road. So we've been actively working on clearing the decks, finalising a lot of incumbent projects, work in progress, reducing the file load, because we definitely believers of the fact that when the stimulus does come to an end, there's a lot of buzzwords, the economic cliff and all this sort of stuff. At some point in time, there will be a day of reckoning, whether that's in October or early next year, depending on when these stimulus packages run out.
Yeah, well, it's when they run out is the big query. I've been watching and reading with interest this discussion of modern monetary theory, which we won't go into here, but it's basically the economic principle that governments can print money with impunity, which I don't personally subscribe to, but there seems to be enough people subscribing to it now, and that's why we're seeing all of this money being floated, and why people like yourself aren't necessarily as quiet, as busy as they might be. I notice. Is it my imagination, or the last time I looked at your LinkedIn profile, I thought the emphasis was on sort of restructuring, but is it now emphasising on insolvency? Is that because, or am I imagining that, or is there an emphasis back on insolvency rather than?
Well, I think at a real small SME level, there's going to be a lot of terminal insolvency. Unfortunately, the restructure process in Australia is cumbersome and costly, and often it isn't able to be accessed by small businesses. The restructuring space is really in larger businesses, maybe micro cap ASX type companies and the sort. Our focus in terms of our firm is definitely in terms of enjoyment and pleasure, is to work on bigger matters, do a lot more restructuring, a lot more deed cutting arrangements, creditors' trusts and things like that. Our genuine fear is that if everyone keeps, we're basically on sabbatical leave at the moment, and everyone's spending up big on their holiday credit card, but they've got no job to come back to at the end of it in a lot of cases. When the stimulus ends, we're going to spend a fair bit of our time on terminal, small type liquidation bankruptcy matters, But indeed, there will be some sizable restructuring work. In fact, we're starting to see signs now of early adopters in the restructuring space. The ones that are keeping us busy at the moment are actually Australian companies that got foreign production plants. Just for access, they cannot get to the production plants, can't travel that easily. The movement of money between countries is sort of stifled. So that's what's keeping us busy at the moment, sort of talking to Aussie-based companies about their foreign travails.
Yeah, it's interesting you say that because, the supply chain is still fairly impaired, isn't it? Whether you're talking medical supplies or all sorts of things, if you're dependent on stuff coming from offshore. I noticed there was an article in the paper today, this COVID thing being a real middle class Sydney being devastated by it, because when you think, small businesses had some relief and there's all sorts of relief, but you've got your white collar workers that are salaried people that they may be working a few days a week less, and they're not necessarily on the receiving end of benefit packages. And I also noticed that some of your larger competitors, even this week, are laying off more and more people.
There's no doubt larger professional services firms have really felt the brunt of this. Almost every of the larger Big Four accounting firms and indeed some of the major law firms have reduced staff numbers. There just isn't the entrepreneurial activity that there was 4 or 5 months ago going on. So logical place for people to cut headcount. Yeah.
Mm-hmm. Okay. All right. Well, look, we'll bring Gary back. I'm interested, Gary. You were saying that you thought that the PE funds were certainly being kept busy putting out fires within their own portfolios.
Yeah, they have been. But also, don't forget, they're under a lot of pressure because most of these are fixed-term funds.
Right.
So, there might be 5-year, 7-year term funds.
Yeah.
And they've still got to get capital out. So they still have to invest. So what we're seeing, and that's why, back to, and we'll get onto it, I'm sure, when retail, a lot of these, what they do when they're getting to the end of their term, the only out for them is to then do a PE to PE transaction. So you see one PE firm who's in a transaction where they offload it to another PE firm. And, there's been a number of those examples, big examples in Australia of that over recent years. And
it's a pass the parcel, isn't it? I know that one of our largest competitors has been handed from one PE firm to the next. So
there's been lots. Quadrant did one to Archer Capital, which is Red Rooster and all that group, etc. And nothing's changed since the 80s when PE really is still looking for leverage deals, leverage transactions. Back to the days that we saw in the early 80s, and that means that they really don't want to put a lot of equity in. And they want to really leverage as much debt as they possibly can. Now, that's great if the business is growing and it's normal, cycle time. But in retail especially, Nick, what's happened, it's a perfect storm because, especially in Australia, our landlords have been far too greedy for too long, looking at, rental rates which are far higher than the rest of the world. Our labour rates are completely out of whack compared to retail rates in the other countries.
Yeah.
And so most of our retailers, big or small, have been working on very small margins.
I'll ask you about landlords in a minute. And that margins thing, I mean, one of the things that I wanted to ask you about, Gary, in particular, was I was speaking to a friend of mine who's an M&A lawyer, and you'd probably know him if I gave you his name. But he made the comment to me that a lot of these funds are very cashed up. They view this crisis. They're ringing him up and saying this is our time, because they believe there's going to be buying opportunities. And certainly for a long time, I mean, even pre-GFC, there was a great capital overhang. We've got very low yields. Investors are very yield hungry. So you would concur that there's a lot of cash on the sidelines?
Oh, there is. I mean, don't forget, you've got funds that are sitting on, hundreds of millions of billions of dollars of capital, and all that's predominantly, here in Australia, superannuation money, in the US pension funds.
You mentioned about, let's say the 5-year closed fund. And you're saying that they can't afford to sit on cash, at the bank attracting, 0.25% interest. But what about the back end of that? If they've got a fund that's closing out at 5 years, it's not an ideal market to be selling to be selling your position in, is it?
It's not, which is why they love to do these PE to PE deals, because what happens is it's a bit of a mates, sort of as a club.
I call it.
We'll give you our investment, and you can sort of when you need to get rid of one of yours, come and talk to us.
Sounds like musical chairs, just waiting for the music.
Yeah, it is. It's a bit of, and so they've got to get out of these, because the last thing they want to do is have to hand back money, to their institutions.
Sule, you heard Gary say that these private equity firms are as busy putting out fires and managing their own portfolios. I know that many of these private equity firms, they're certainly lean when it comes to personnel. I mean, that's their model, is to run lean. They've got lots of firepower in the brain department, but not necessarily, So we see that banks, for example, lean on the insolvency profession to fill the gaps, and you hear about insolvency people being seconded to banks. Is that something that happens with private equity as well?
Well, I sort of agree with what Gary said about the PE to PE backed deals. The problem at the moment is there's 2 problems facing private equity at the moment. There's no genuine secondary market for these assets or business. Right? Okay. And then if someone is really keen on an asset or a business, the major issue they're faced with at the moment is at what point in time after the transaction that I enter into will I be able to conduct business in an ordinary course of business, normal basis? I mean, look at the travails Bain have had to face with Virgin. They're doing a transaction to acquire part of the business, part of the assets. But what they really don't know is when do people start flying and travelling at a normal pace. So everything is skewed by this massive unknown, which is future time.
Well, I mean, I didn't really want to. We've spoken about Virgin in recent weeks, but I don't want to get bogged down in that. But it is. I mean, that's not over yet, is it? I mean, the bondholders are still making a hell of a racket.
Yeah, they're all going to face the same problem, though.
Yeah.
At the moment, the administration process looks like it's essentially an asset grab and a debt compromise vacuum, but it hasn't addressed the go forward operations of the business.
Yeah, well, that's a big question. I mean, look, I know that we, sometimes as a lender, you miss out on a deal. You fight hard to get the deal, but then you miss out on it. The terms, of course, your competitors are slicing away at the terms and diminishing the security and forcing the price down. And sometimes it gets to a point where you miss out on the deal, and you go, you know what? At the end of the day, that it was the way it was sliced and diced. I'm kind of glad I missed out on it. So we'll go to our headlines. The first one here is private equity under the spotlight as retail victims pile up. Then we've got RM Williams, El Catton Chair, defends private equity role in retail. What is it? I mean, as a Greek, my family always were retailers, little shops, of course. But most Greeks that have been through what I went through, that they say to their kids, for God's sake, don't go into retail. Well, what is it, Gary, about retail that holds such an attraction for private equity?
I think it's scale. If you've got a good retail model or a concept, it's very easy to go and open 100 stores or 200 stores. It's not huge capital investment, up front to open up a retail shop.
Yeah.
And in the US, you can see retail, you can go from 0 to 100 stores in no time, because there's plenty of places to go. And at the same time, here in Australia, you have for years, Westfield, every time they were opening a new location, they would invite retailers to go along. So it's a pretty easy you can replicate it. It's a cookie cutter concept.
Yeah.
And that's fine if you're making the margins. And, you go back 15, 20 years ago, a 50% gross margin was normal, and you could make profit at 50% gross margin. Now you've got to make 68%, 70% gross margin, because you're paying anywhere north of 15% on your sales in rent, and you're paying $23 to $25 an hour for your labour. So the economics don't work, and which means you've got to have more retail stores. You've got to try and get volume, and then keep your corporate overhead very low, and hope that you get a couple of percent falling to in operating profit, falling to the to each store's profit to the bottom line.
It's interesting. I mean, I'm no stock analyst, but if you look at it's how Webjet, for example, has lined up against what's the one that's got all the retail locations?
Flight Centre, was it?
Flight Centre. And now Webjet's shares they've come back a bit, but they went up, I think, because they have a web-based model. And I read in one of these articles that I sent around that the private equity guys are saying, look, the model's changing. Instead of having 200 stores, it'll be 25 stores plus a really strong web presence. Are you seeing that, Gary?
Yeah, look, what's very, very important, and we obviously spend a lot of time looking at what's happening in the US. If you look at the US retailers that are doing well, it's where they years ago made a huge investment into their online business. Yeah. So if you look at them now, they've really created a very successful, online, non-bricks and mortar business. So they may still have a few bricks and mortar stores, but the majority of their business is moving towards online. The ones that we're seeing that are collapsing are those that did not make that transition, and the successful ones made that transition a long time ago.
Okay, listen, I've got a couple of queries for you on this, Sule, with respect to retail. I mean, I haven't done a deep dive on all these retail VAs, the big ones that are making the news. I mean, is there an element of bringing the landlords to the negotiation table? Is that part of the story in any of these? I know as an administrator, you're right across obviously the rights of landlords versus the company in VA. Is there an element of that?
I think it's and the reason why there's a proliferation of these retail collapses. I think we've touched on it in a loose fashion. There's too much debt. The labour costs it is Australian centric, of course. The labour costs are too high. The property costs are too high. There's too much debt, and in a lot of cases, they haven't implemented or adopted a proper e-commerce type delivery strategy. Yes, the rents have caused a lot of issues, but at the moment, you get the feeling there's an expectation gap between what landlords think they should be getting and what they're entitled to be getting, and they're diametrically opposed from tenants. In 6 months, 12 months' time, I think that expectation gap will narrow and there'll be better deals done.
Yeah. I mean, as an administrator, I mean, one of your jobs obviously is always to write the report and tell everybody what went wrong.
Yeah.
And because we've had such an incredibly low cost of capital, as I say, official interest rates are, for all intents and purposes, nothing. I mean, you can lease a car now for, I think, 2 point something, 3 point something. I mean, do you think that the very low cost of capital is it allowing business models that shouldn't work where they would not work under a normal capital base? I mean, is it just, what do you think about that?
Well, I still think a lot of the major banks and financial institutions in Australia are supported by real property in their terms of their lending. They may call it business lending, but if you scratch beneath the surface, it's supported by property. So what you really have in the SME sector is mums and dads and family businesses leveraging their personal assets to support these businesses. It's not like they're lending, have massive exposure just on retail businesses in isolation. Yeah. No. Yeah. I think that's a bit of a furphy. Yeah.
And Nick, that's where the banks got sort of a bit carried away because there was a large private equity group involved. They just felt a bit more comfortable, but they weren't really looking at what their true security was. So that's part of the issue. And so in many cases, it wasn't the cost of capital; they breached their covenants. And that's where then the banks started to get nervous.
I guess to some extent, there is a mindset that if some private equity firm has got a whole lot of equity on the table, that they're going to work very hard to make sure the bank is kept whole. Because if the bank's not whole, then the private equity people are getting torched. On the other hand, a lot of these funds aren't necessarily, they're managing other people's money. With all due respect, I mean, is there an element of that?
Oh, definitely. I mean, you're seeing that today. I mean, I think an interesting transaction has been this one with the Rockpool Group, and they were, Quadrant, who were in there as the private equity group, they were looking to sell, either float that business or sell it in a year or so ago. Then all of a sudden they start to have issues with, underpaying of employees, etc. And then Perry wanted to buy back, a bunch of them and had private equity prepared to fund him to do that. And then they pulled out because of coronavirus. They'd certainly have banks, tapping them on the shoulder saying, guys, you need to help us out of this or sort it out. I mean, they'd be very nervous.
Yeah. I mean, to what extent is there tension between the private equity investors and the senior bank debt holders, Sule? I mean, have you experienced that?
Well, I think at the core of it, as Gary alluded to at the beginning, private equity guys want to get into this and they want to build scale, they want to build distribution, and they want to get a massive footprint as quickly as possible. And cash flow in isolation is okay in that environment. But when they get into our sort of sphere in terms of restructuring space, the first thing we do is look at profitability of stores and reduce the footprint to focus on the profitable stores. Yeah. So the banks are quite favourable. They've got meaningful private equity balance sheets going into businesses, reasonable management teams. Cash flow is good, repayments are okay, but profitability is a bit of an issue. And over time, if businesses haven't morphed especially their e-commerce platforms in different directions, they come unstuck. I mean, when we restructured Pieface a couple of years ago, first time, there was 55, almost 60 stores. The first round of restructures, we dropped that down to about 25, 30 stores, and that wasn't enough. So we managed to achieve a compromise, a reduced sort of footprint. But really, that wasn't enough. What they still had to do was get their manufacturing capacity up, because they had a mass production facility and they're only producing pies for their own network. Crazy. Business plan has now changed. They're now supplying pies for petrol stations and things like that. And voila, you've got a bit more of a success story. But it took $75 million lesson to get there.
Yeah. Look, one day we'll share a pie and talk about Pieface. We've had this. Obviously, we were all wondering about the September cliff. And now the banks, I think, with a little bit of pressure from APRA, have said that they are going to extend the payment holidays from September by another 4 months. They have emphasised that you're going to have to qualify for this. They're not just going to hand it out willy-nilly. They've also, so you've got to qualify for it. At the same time, there's an article here, the banks are pleading with their customers to restart payments. So on one hand, they're saying, yes, we're going to extend your holidays by 4 months if you really need to and if you can prove that you can pay it back. At the same time, if you can start repaying, listen, don't wait till September, start paying now. And on top of that, the government has said that they're going to extend JobKeeper. I imagine, I haven't seen any detail on that, but I imagine that'll be on a qualified basis as well. And they've said they're going to extend the concessions on insolvent trading. So, but by the same token, I've got this email here from the president of the TMA, the Turnaround Management Association, saying that they support the government in everything that they've done. But by the same token, everybody's saying, the TMA and the government and the banks are saying, we want to avoid zombie companies. So how do they do that, Sule? What do you see in all of this?
Yeah. Well, at the outset, I'm totally against extending the holidays. I think there's a real problem. The questions that are really at point here: how many good businesses are going to be caught in a trap of extending credit to underperforming companies that are going to end up getting pulled into this vortex at the end of the stimulus period? How many companies who weren't productive before COVID have managed to access things like JobKeeper, have rolled the stone down the road a little bit longer, who will be in worse shape at the end of the stimulus package? I believe on a humanitarian side, support and job seeker and social needs should be met. But as far as the business community is concerned, the more normal course of flow of funds, debt and repayment should begin to almost lubricate the system. This is going to be an absolute diabolical sham if this goes on for another 6 months. Essentially, people are spending on holiday on the credit card, and they will come back and they may not have a job to go back to.
Yeah, well, I mean, it's all part of this religion of modern monetary theory, which is a real bee in my bonnet at the moment, which is the governments can just keep printing money and paper over everything. I've got one of our viewers makes the comment that the banks are very particular about lending to clients that have deferred payments. So you certainly want to be cautious about extending your payments, because the banks don't like it. I mean, they obviously understand, and as I say, I'm sure that they've got the pressure from above to do that. What do you think, Gary? There is a bit of moral hazard here as well.
Yeah, there is, but you know what? A lot of these companies are in intensive care at the moment, and you know they're on life support. And really, by extending, all you're doing is extending the life support, when in fact, really, what you should be doing is cutting it off. You know, we will reach a time when the banks will go back to their normal practice, which is, you know, as soon as a company defaults or as soon as they have a problem, they'll put them into workout. So, you know, a lot of this is just, you know, all looks lovely and nice for the companies today, but we'll go back to normality. Whereas a lot of these companies right today, they should be simply unplugging the life support and letting them go now, you know, because they're not going to come out of that. You know, the cancer's too great and they've already had it.
Yeah, I mean, look, it's interesting that you say they're going to go into workout. I did read one of these articles here, and I can't quite put my finger on it now. But for a start, analysts, you know, stock analysts are saying, well, you know, you can extend payments on loans, but we're still going to penalise the banks and treat you as if a lot of those loans are actually impaired. But the other thing is that I think that banks are still going to try and find a way, if they think that you are a zombie company, or that you know, they are going to try and manage you out. I mean, what do you? There's a quote in there somewhere, Sule, about helping. You know, the banks are going to want to help you. Do you think they're going to be looking, you know, calling you up and asking for a restructure, or?
I think they're currently in the vortex of trying to be apparent that they're doing everything they can to help all of their borrowers. And there's a massive government push to ensure that all these financial institutions do the best they can. But the reality is, once you get through all the gilded lilies, is compound interest is working against the borrowers. It's building up at a quicker rate than it was before. The capital needs are going to be massive. And at some point in time, the banks will be banks, and they will call the debtors ledger in. They just will.
Well, I think from your point of view, Sule, I mean, you know, you mentioned then compound interest, and the issue with that is that it's eroding wealth. I mean, you know yourself that it's one thing to wrap a company up or to restructure the company and find a way forward and preserving the wealth, you know, the wealth of not only the shareholders, obviously, but of all the stakeholders. Whereas if these things are perpetuated, wealth gets destroyed, and you find yourself appointed to the liquidator of something, as one of my friends in Queensland likes to say, it's a sucked orange.
Definitely, if the bank's already got reasonable security, you know, this compounding of the interest, you know, as long as they don't breach their covenant, you know, they're fine, you know, but eventually you'll get to a point where if they keep on compounding that interest, they will start to breach their covenant, and then you'll start to have issues.
Yeah, the only thing there, Gary, is that banks are, you know, I think banks have been putting up with breach covenants for a long time. I was talking to a friend of mine in one of the major banks the other day, and they were saying, you know, termination notices are verboten. You know, there's just no way. No one's allowed or authorised to send out a termination notice.
That's in the current environment, and I think you're right. But that will come to an end. You know, the honeymoon will come to an end. You know, and they'll go, because the banks have got shareholders as well. And, you know, and then when they start having to account for their bad loans, you know, we're going to start to see some issues. So, you know, it's a holiday period, as Sule said. You know, they're on holidays, and everyone's going to come back with the credit card completely maxed out.
Look, I made a comment I think last week that it is something of a holiday, and if only we'd known this was coming last year, we could have planned for it and you know, made better use of all this time. Sadly, now you know, I really hope that what's happening in Victoria doesn't spread across the border, but I guess we'll wait and see. Look, we will wrap it up there. I'll just ask you for any final thoughts on where you see things heading in the next couple of weeks. I'll start with you, Gary.
Oh, I think we've all talked about it. I think the big challenge is going to be what happens at the end of September. You know, it's not going to just be that job seeker and job finder and all these things fall out. But landlords are going to start being under pressure. Tenants are going to start reneging on. I think tenants will just walk away from there at the end of this 3-month moratorium period. They'll just walk away from there, and the courts are going to be tied up with lots of small claims. So you're going to have landlords in trouble. You're going to have so it's a bit of a tsunami. I think is going to happen from after September.
And what about you, Sule?
Well, it's just farcical. I think I could take some credit from Gary today and make him wait 6 months before he could enforce it. When my circumstances or my ability to pay him aren't considered, it's an absolute joke. And I think it'd be a terrible mistake if they extended beyond September. It should be a hell of a lot more targeted than it was previously sort of issued.
Well, the trouble is that we live in a society now. We're in the society of the participation award, and we don't want to hurt anybody's feelings, and et cetera, et cetera. So maybe that's the fruit that we're harvesting now. All right, listen, we'll leave it there. Thank you very much to Sule Arnautovic. Thank you very much for joining us again, Sule. Very grateful to you for that.
Yep.
And thank you to Gary Blom. Really appreciate your time and your expertise, Gary, and your contribution. Thank you.
Yeah, pleasure to help me.
Thank you very much to our live viewers, and thank you very much to those of us that are watching us over the weekend or listening to us via podcast. And we'll speak to you again soon. Cheers.